Welcome to ERISA Fiduciary Services presentation on managing retirement plan fiduciary risk. The objectives for this presentation are, first, to understand exactly how one becomes a fiduciary and the significance of that. Next, to understand the challenges that these fiduciary obligations present to your clients. And finally, to provide some unique and effective strategies for understanding and eliminating these risks. The main problem facing plan sponsors is that they don't understand or appreciate the fiduciary obligations they automatically undertake by sponsoring a retirement plan, along with the personal liability these obligations bring with them. No one ever sits down and educates them on what their risks and obligations are, let alone provides them with strategies to manage those risks. As a result, they rely too much on plan service providers who almost always do not take on a fiduciary role for the plan. Typically, this only came to light when something went wrong: a DOL investigation, a participant complaint or lawsuit, an IRS audit. More recently, though, because of the DOL final fiduciary rule, we've been seeing more and more plan fiduciaries making efforts to understand and reevaluate their existing setup based on news items they've run across on the final rule. As they do this, they're often surprised to find out that they haven't been getting the level of protection the DOL recommends, and that they've been unwittingly steered into investments that benefited their advisor rather than the plan. So fiduciary issues are becoming a growing concern for informed clients and an enormous opportunity for providers who've been paying attention. In order for you to be able to properly educate and advise your clients, we need to first start with a basic understanding of what a fiduciary is and what legal significance there is to becoming a fiduciary. The important thing here is that ERISA, which is the law that regulates retirement plans, uses a functional definition of fiduciary, which means that if you're doing fiduciary things, you're a fiduciary whether you agreed to it or not and whether you realize it or not. So anyone with discretion or control over the plan's operations or over its assets is a fiduciary, whether they know it or not. And this is further complicated by the fact that when plans are initially set up, plan sponsors are often slotted into fiduciary roles without their knowledge or consent. For example, ERISA requires that every plan have a named fiduciary, and the plan sponsor is usually the one named in the plan documents as that fiduciary, without first being consulted. Every fiduciary has personal liability, which is an extremely important concept we'll discuss in the next slide. When it comes to liability, we're all familiar with the corporate model. If you incorporate your business and something goes wrong, you can shut down the business and still walk away personally intact. That's one of the main reasons for incorporating in the first place. But this model simply doesn't apply in the retirement plan area. If something goes wrong, the DOL and the courts will require a fiduciary to make things right, even if that means the fiduciary has to reach into their own pocket to make the plan whole again. That means if you're a retirement plan fiduciary, your own personal assets are always at risk. That's very important and bears repeating. If you're a retirement plan fiduciary, your own personal assets are always at risk. This is something most of your clients are not aware of. And even those few who are aware still have trouble coming to grips with the concept of personal liability because they're so entrenched in the world of limited corporate liability. When something goes wrong, it's not just a matter of making the plan whole again. There are also significant fines and penalties added on by the DOL and IRS. The DOL comes up with a number that will make the plan whole, and then it adds another 20% on top of that as a penalty, which the fiduciaries are also personally liable for. And in the case of prohibited transactions, which generally involves self-dealing between a fiduciary and the plan, or an instance where the fiduciary puts their own interests ahead of the plan. In that case, both the IRS and DOL can impose penalties starting at 15% and quickly escalating to 100%. The attitude many plan fiduciaries take here is denial. It'll never happen to me. But the fact is that the DOL collects a tremendous amount of money every year, over $1.6 billion with a B. And once they initiate an investigation, the odds are stacked in their favor. The DOL is successful almost 73% of the time. And even when the DOL loses, there's still a considerable cost to the fiduciaries for legal and other fees. And that's just for the DOL. The IRS has their own separate enforcement and audit tactics. Given that the fiduciary's personal assets are at risk here, it only makes sense for them to seriously consider practical strategies to avoid this type of situation altogether. The fiduciary duty has been called the highest duty known to man. It means that a fiduciary has to put the plan's interests ahead of everything else, including the fiduciary's own interests. To do this, the fiduciary is required to act exclusively for the plan participants and to do so prudently. They have to diversify the plan assets and follow the terms of the plan. This chart summarizes the primary fiduciary roles for a plan. Starting with the bottom row, you have the plan administrator under Section 316 of ERISA. The plan administrator is responsible for the day-to-day operations of the plan, for the reporting to the government, things like the 5500 form, and for the disclosures to the participants. Under ERISA, by default, this role is filled by the plan sponsor, whether or not they are aware of it or agreed to it. Now, there are various vendors out there that offer to act as so-called 316 providers, but there are several limitations to this approach. First, there is no consistent standard for what a 316 provider must offer, and many of these providers do not include everything that's required under 316 in their services. So there ends up being unexpected gaps between what the plan fiduciary needs and expects to be covered under 316 and what the 316 provider actually covers. More importantly, a 316 provider gives only limited protection for one aspect of the plan. Even if you have a 316 that provides complete plan administrator coverage, the fiduciaries are still personally liable for everything else that goes on with the plan, including the plan assets. For the plan assets, the fiduciaries will almost always retain an investment professional. This investment professional may take no fiduciary role for the plan, or it may provide its services on a fiduciary basis. A 321 investment manager provides advice, but the plan fiduciaries are free to accept or reject that advice. As a result, both the 321 and the plan fiduciaries are liable for the plan assets. A 338 investment manager has discretion over the plan assets. The plan fiduciaries will be kept in the loop on what the 338 does, but it is the 338 that has control and therefore liability for the plan assets. And so the plan fiduciaries are relieved of liability for the plan assets when a 338 is used. But again, regardless of the type of investment professional used, the plan fiduciaries at best are only getting protection for one aspect of their fiduciary obligations, namely the plan assets. They are still personally liable for everything else that goes on with the plan. Standing above this all is the name fiduciary under ERISA Section 402A. The name fiduciary is responsible for everything that goes on with the plan, including the plan operations, the reporting and disclosure, and the plan assets. ERISA requires this in order to ensure that someone is ultimately responsible for the plan's fiduciary obligations, and that someone is specifically named in the plan documents. In this way, the DOL and participants will know who to look to. And you'll recall that the plan sponsor is typically put into this role of named fiduciary when the plan is initially set up, often without their knowledge. So the critical link in this chain of fiduciary liability is the named fiduciary. And our solution is to remove the plan sponsor and fiduciaries entirely by stepping into the role of named fiduciary. The only role the employer still fills is that of plan sponsor, which is not in and of itself a fiduciary role. What does this solution provide? First and foremost, it shifts the personal liability from the plan sponsor and fiduciaries to us. This is done smoothly and seamlessly. We remove the employer and its owners, officers, and employees from the chain of personal liability. All existing plan providers are unaffected by this and remain in place. The fee for this is minimal and can be paid from plan assets, so there is no direct cost to the employer. And for plans with existing investment professionals, it ensures that they meet the requirements of the DOL Final Fiduciary Rule. The overall effect of the DOL Final Fiduciary Rule is that virtually all investment professionals who provide investment recommendations for a fee will become fiduciaries. Once they become fiduciaries, they have to put the plan's interests ahead of their own. Most brokers are used to the suitability standard, which requires that when a broker recommends a particular investment, they reasonably believe the recommendation is suitable for the client. But under the DOL rule, the suitability standard no longer applies. A recommendation must not just be suitable, but in the best interests of the plan. As a result, most investment professionals will be hard-pressed to get paid on anything other than a flat fee basis. If their compensation can vary based on their recommendation, for example by steering the plan into commissionable products, they will have to demonstrate that this is in the best interests of the plan. For many plans with an existing investment professional, that professional may not be willing or able to provide its services on a fiduciary basis. By acting as named fiduciary, we take on fiduciary responsibility for the investments, and we satisfy the DOL rule. This allows any existing investment professionals to remain on the plan, even if they continue to act in a non-fiduciary capacity. As named fiduciary, we are responsible for everything that goes on with the plan and provide comprehensive services to relieve the plan fiduciaries of their personal liability. This includes plan qualification, reporting and disclosure, plan investments, monitoring providers, benchmarking fees, and implementing formal review and documentation procedures. For plans under $2 million in plan assets, the fee is a flat $1,200. For plans under $5 million, the fee is $2,400. For plans above $5 million and for those with non-standard features, such as employer stock or self-directed individual brokerage accounts, we can provide custom pricing and solutions. Thank you for your interest in ERISA Fiduciary Services' unique strategies for managing retirement plan fiduciary risk. We look forward to working with you and your clients.